Yesterday in Dallas, Federal Reserve Chair Powell said that the Federal Reserve was in no hurry to reduce short-term interest rates or its policy rate. There's a reason why the Federal Reserve is hesitant to further reduce its policy rate, and it comes down to core inflation. In his speech yesterday, Powell said, core measures of goods and services inflation, excluding housing, fell rapidly over the past 2 years. Notice he said excluding housing. If we look at the most recent inflation rate, notice the core inflation rate's increasing, up over 3% in the past year. That's the impact of housing. Shelter costs continue to rise almost 5% a year and contributed almost 70% to the year-over-year inflation rate of 2.6%. Why are shelter costs, which include rents for apartments as well as the implied rents of owner-occupied homes, why do they continue to increase at 5%, keeping that core inflation rate up and preventing the Federal Reserve from cutting its policy rate as aggressively as it might like? Well, it comes down to a housing shortage. There are not enough houses in the U.S. This is from the San Francisco Federal Reserve Bank. The blue line are new housing completions. The green line is housing formations. And there is a big gap, way more household formations versus completions. There are not enough houses. That is why rents and owner equivalent rents keep going up. The other concern for the Federal Reserve, and we can see this in one of our charts from Asset Camp, our stock and bond market index research tool. This chart shows the difference in yield for 20-plus year Treasury bonds compared to U.S. 1 to 3 year Treasury bonds. As the Fed cuts its policy rate, shorter-term rates have fallen, but longer-term rates have increased, and so we see an increase in that spread. The yield curve is steepening. Longer-term rates are going up, and they're going up because inflation expectations are staying elevated, particularly for core inflation, and there's greater uncertainty with the Trump administration coming in. Investors are demanding additional yield, called a term premium, for uncertainty regarding inflation and the direction of the economy and the administration. So while the Federal Reserve is in no hurry to further cut their policy rate, they certainly have a lot to worry about when it comes to core inflation and the direction of longer-term interest rates, which continue to rise.